Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast on life insurance.
That's right. It's a long and distinguished list.
Longest running, I think, is one that we can legitimately claim at this point.
Or we could phrase it another way. The only two people dumb enough to do a life insurance podcast for as long as we've done it.
That one we win by a lot.
Yes.
By like a lot.
Mm-hmm. But you know what? Today we're going to talk about everyone's favorite subject.
Whole life insurance.
Yeah.
Mm-hmm.
We'll have like 7 or 8 people listening this week.
Sweet.
Up from 5.
We enjoy the company. So welcome.
Oh, let me rephrase it in marketing speak. We had a 25% increase in our listenership this week.
Hey. Somebody's working on those marketing skills.
It's right up there with we've paid the most dividends we've ever paid.
That seemed oddly specific.
Well,
anybody in particular you'd like to mention, Brantley?
Actually, there's more than one. We're all guilty of it.
Oh, so we're actually starting a brand new thing with a podcast that's been around for 12 years.
More than that. Keep going.
More? 13, 14?
Like almost 14.
Wow.
A monument to our stupidity.
That's okay.
No,
so
14 years. Yep. I think September, August, something like that.
Yeah, it was September. It was September that we sat down and did the very first one.
Mm-hmm.
I do remember. So nearly a decade and a half in, we finally decided, hey, let's actually talk about what we do with life insurance.
Yeah.
Like not theoretically, we do that all the time, but like practically, like let's talk super specific details.
Yeah. Go ahead. I'm waiting for it.
I'm sure there's a bunch of people that have always been wondering about that. So here we go.
I'm wondering, what do we do?
So I'm just that other guy.
Yeah.
I wait.
What is it that we do?
So we're gonna go through this or revisit this sort of thing from time to time, and today we're going to specifically discuss the application of whole life insurance as a safety play in a let's call it portfolio diversification play. We've got to get all of our industry vernacular and jargon buzzwords out there as we can.
Mm-hmm. Mm-hmm.
Start with a kind of basic setup of all this, which is for somebody who finds themselves in a position of some sort of win or gain or lump sum that they really didn't foresee happening.
Right.
So maybe they made a really chance investment that just went really well.
Mm-hmm.
Maybe they own some real estate that appreciated and they decided, you know what, time to bounce on this location. We're just going to cash out and do something else with the money for whatever the reason. Perhaps they have a business and somebody came along and made them an offer that they couldn't refuse. Or maybe somebody left them money. Whatever it is. But they've got a sum of money and they want to kind of ensure that regardless of what the future holds, they're going to be able to maintain some sort of basic stop loss on that balance.
Yes.
So they're going to take the money and they're going to reinvest it, but they want to do that in a way that ensures kind of a minimum result.
Right.
And one option is just hold it in cash, but cash can be kind of unappealing to a lot of people for all sorts of reasons. So whole life insurance is a fantastic way to keep liquidity similar to cash, but get a return that is quite a bit better with a bunch of tax efficiency along the way.
Yes.
So that is where we would introduce whole life insurance in this conversation.
Right.
To note, because we've done this a time or 15, when people find themselves in this position, there are they're limited numbers who are pretty risk seeking and they decide, let's just double down and make it rain again. Generally speaking, there's some anxiety that people face in this position because they have this win and they understand that it's kind of unusual. And so there's a certain amount of protecting the win that they think about.
Yes.
Because they'd rather not lose all of this.
Yeah, I would say the people that we've worked with who were realistic about a big win have the presence of mind to realize that, hitting a grand slam in the World Series probably odds are is going to happen one time.
Mm-hmm.
It's very hard to duplicate. I would say the converse is you and I have both known people who took big wins and quote unquote tried to parlay that into the next thing.
Mm-hmm.
And I'm not talking about anybody specifically. This sort of general mentality of I got it all figured out. And so, I did it once, I can do it again. I would say the more prudent people we've worked with realize that the likelihood they're going to be able to do it again is probably pretty low.
Thought process brought to you by Humble Pie Incorporated.
New sponsor. Unfortunately, we also own that too, so it doesn't really do anything for us. But
as somebody who has had decent-ish wins here and there and thought, I figured the world out. There are times you learned that no, you didn't.
Right.
And so that is where we start to allocate some money, not all the money, but some of the money to something like whole life insurance to ensure that we have other options on the table. Yeah. Because whole life insurance at its very core, there's lots that is said about whole life insurance and what it's supposed to do for you. But I have always argued that the one thing that it does better than anything else is leave options on the table.
Right.
And when you have that,
you still have access to cash.
Yeah. When you have that, there's a lot of really great things that can come together for you.
Yep.
So, specific circumstances to give you a walked through case study. This is an individual who made some very great investment decisions a few years ago and resulted in a pretty substantial sum in their possession that they didn't really think was going to materialize when they first set out to make these various investments. Results far exceeded expectations and landed in a position of having roughly $5 million in investable assets at an age nowhere near where they thought they would have accomplished anything like this.
Nowhere near retirement.
Yep.
Right.
So the decision or the thought process was, all right, what do I do now? Because I've accomplished this. I'm not so convinced that if I just keep doing what I've been doing, this trajectory continues.
Right.
And so I'm going to have to decide what else I do from here. But one thing that
in a very realistic posture.
Yeah. Yep. But the other thing that I really don't want to do is double down and have this all go to zero.
Right.
Or even have it all go to $1 million. Because that'd be a big loss.
Right.
So the decision was to take $2 million and put it into whole life insurance.
Mm-hmm.
And keep the other $3 million in other more risk-on style assets.
Right.
The approach here is unique, and this warrants spending some time walking through. When somebody is in possession of all of the money they intend to put into a whole life insurance policy, we would approach the design of that policy very differently from the individual who shows up and says, hey, I got an extra $30,000 a year I would like to save, and I think whole life insurance is where I want to save it, so what should I do?
Right.
Because in that case, they are not in possession of all the money right now that they intend to put into the whole life policy.
Right. Mm-hmm.
So for the individual who is in possession of all of it, there is an approach that we take, and it does pretty dramatically change the design and the execution of the whole life policy. Mm-hmm. Now, there are some finer details that are very, very specific company to company that we're not going to get into intimately here. But in general, what we would look at is a intentionally limited number of payments going into the whole life policy.
Right.
Now, for the layperson who is very, very new to insurance and focusing on the cash buildup of insurance in general, I'm sure there's a question they may have, which is, well, if I've got all the money right now, why don't I just put it all in the policy right now?
Yeah. And we know that's what people think because that's a common question that we get.
Mm-hmm. And the answer is, well, technically you could. But if you did, one of two things would happen. Either you would indiscriminately put the money in there and not worry about the death benefit of the policy, which would create a modified endowment contract.
Right.
Which would remove a substantial amount of that tax efficiency I mentioned earlier.
Mm-hmm. Mm-hmm.
Or you could try to avoid that situation, and you could ensure that your death benefit is adequate to avoid modified endowment contract status. But the amount of death benefit you're going to need to do that will become counterproductively expensive, which means your rate of return on cash value buildup is not going to be ideal.
Right.
So what you have to do instead is strategically and systematically put the money into the policy over a certain number of years.
Right.
The exact right number is going to differ on which product you ultimately choose, your age, the amount of money we're talking about, and a couple of other variables.
Yep.
And those are the things that we fuss about. That's not something that you, the individual, need to be trying to completely sort out and maximize.
Right.
Those are the things that we are trained to take care of.
Right.
And compare across different product options, different companies, things like that.
Yeah,
but
and
just
then bring them to you and go.
Yes,
look, these are the. I'm just making things up, but these are the three most efficient choices. Mm-hmm. And here's the pros and cons of each one.
Yep. And why we would do it this way instead of that way, and why this one's showing you 5 payments and that one's showing you 6 payments, for example.
Right.
So that is a critical understanding here, because a lot of people might think, and it makes perfect sense intuitively, that, well, if the money goes in there sooner, then it can be growing faster, and that would be better for the sake of maximizing the rate of return on the cash value. And you are correct, except for there are some rules, mostly involving the tax code, that stop you from doing that practically.
Right.
So now we have to balance enough money to benefit from as much money in there growing as soon as possible against the amount of death benefit that we would have. And there is a way to thread that needle, and that's what we're experts at.
Yeah.
So once that gets done, the policy is designed with the intention that the money will move into the policy over that number of years and then stop. And you won't make future payments into the whole life policy, and now it'll just grow in cash value.
Right. In the case of the $2 million, it ended up being 5 years, right?
One was 5, one was 4.
Okay. It's been a long time ago, so I don't remember.
Yep. Sometimes it differs from company to company or product to product.
Yeah, because this individual decided 2 different.
Yep.
Different products.
I did mention that we actually split it between 2 different companies.
Right.
So when you do this, obviously you now have cash building in these policies, and you do have cash building at what seems like a pretty quick rate relative to the person who's just putting $20,000, $30,000, $40,000 into the policy each year. Now, ultimately, the rate of return between those two, it doesn't differ substantially necessarily.
Mm-hmm.
But it does put you in a position where, because of the lump sum, because of the large amount of money going in there, just in absolute dollars, you've got more money sitting in the whole life policy early on.
Yep.
The other thing that this does afford, when it's done correctly, is the option to potentially put more money into the whole life policy later.
Right.
So we might set it up with the expectation that there will only be 5 payments.
Right.
But you get to year 6 and you go, the other money, the other $3 million, that we kept risk on. And again, it's done a little better than I thought. So what if we were to continue to put money into the whole life policies? The answer is we can do that. The degree to which we can do that does vary a little bit, but we know how to navigate that. And the insurance company does too. So it's not the case that you'll say, well, all right, I put more money in there, but oopsie, I created a MEC and I didn't know about it. So now it's all taxable. That doesn't happen.
Right.
If you contribute more than planned and you cross that line, the insurance company will tell you and give you more than adequate time to reverse that action.
Yes.
So
we've never personally met anyone who accidentally created a MEC.
Yes, we didn't have to deliver the news sometime down the road that, oh, you didn't know this. But so the strategy here is to create this other asset. And this particular case study, which is, it's been several years since this was done. The risk on assets have done reasonably well. The whole life policies have done exactly what we thought they were going to do.
Right.
And so this person has accomplished the de-risk with a very reasonable rate of return from the whole life policies, but stayed in the market benefiting from what that delivers. And that has always been advocacy here.
Right.
That we are not trying to convince you everything has to come out of the market and go into life insurance.
Right.
We don't think that. We don't think there's any advantage to doing that. We just see the advantage from a diversified risk standpoint with the life insurance policies.
What? Insurance guys who think about risk? That's what a concept.
Now, if we were to go back and perfectly time the beginning and end dates of the investment, like the risk on side of this, take all $5 million from back then, get to now, see what the balance is versus where we're at because we use some money to go to whole life insurance and some money to stay in the market. We'd have a difference.
Let me guess. You'd have more money.
Yeah, you'd have more money.
I mean, it was a shot in the dark, but I just thought.
Yeah. It was a shot in the dark, but it was a shot in the dark in the right direction. So.
Well, I only said it jokingly to make the point, like, that's never the point that we're trying to make.
No.
Like, we're never trying to say, you're going to have a better outcome. Well, it depends on what you mean by better outcome.
Right. In fact, the difference is about $1 million.
Of if they had stayed 100% risk on versus.
Correct.
Yeah.
Which I know there are plenty of financial pontificators out there who will clutch their pearls and go, see, you get screwed when you buy whole life insurance. Here's the thing. Net worth at this point.
Funny because you captured the sentiment so well. You spend a lot of time in the Bogleheads group, don't you?
Too much time. I have a super secret Reddit account that I use just to stir the pot there. No, I don't. I have one Reddit account. Here's the thing, though. We're talking about somebody who's got like an 8-figure net worth now.
Yeah.
So $1 million. Yes, I know. Right. Must be nice to have their problems. I get it.
Right.
But ultimately, the supposed cost.
This person went to this with eyes wide open, like not delusional about the fact that this was going to outperform.
Exactly. The supposed cost here, which again, we're kind of ending the chapter before we're ending the book before we finish the chapter.
Right.
Because that's just where our things right now. That's just where things are right now. That's what I meant to say. And so perhaps there's $1 million difference. Perhaps there's a bigger difference. Perhaps there's only like a $250,000 difference if there's some sort of market correction or whatever.
Right.
We don't know. We know where things are right
Sure. So we should have taken a snapshot in 2022.
Yeah.
A different story.
Yeah, very different discussion. Very different discussion. So it obviously costs something to have the safety.
Of course.
But there's a coordination of these things that allows this individual and anybody else who does this to lean on one versus the other when the time warrants it.
Mm-hmm.
So what whole life insurance brings to the table here isn't just returns, it's options. I mentioned that earlier. So if we get to retirement, and this person is not that age yet, and there's a market correction.
Yep.
There is ample money to use whole life insurance for income needs and not touch any of the market exposed stuff.
Right.
And let it do its thing.
Mm-hmm.
And when the market is going well, they can take from the market style assets. And they might even decide that if market's bad, we take from whole life, then market goes really well, and we now have a sort of outsized gain on the market side. Why don't we just take some of that outsized gain and put it back into the whole life insurance policy by paying down some loans?
Right.
We have shown a few times in the past that that's a pretty good winning strategy for augmenting the income capacity of whole life insurance.
Right.
So it oftentimes isn't so much about
and that's such a basic concept. I mean, everyone can wrap their head around don't sell assets when they're worth less.
Mm-hmm.
I mean,
yeah. And it's really easy to talk big in the moment when it's not your money or it's not your anxiety.
Yeah.
So like it's super easy to tell people don't sell assets when they go down.
Right.
And then you have what we just lived through over the past 3 months.
Mm-hmm.
And a lot of people look at their portfolios and they look at the trading day and they look at the rest of the week and they go, I don't know where the hell things are going from here.
Welcome to the club.
Should I sell? Should I not sell? I don't know.
You're in good company.
Yeah. It's hard to stay the course is the point.
Yes.
And sometimes it's not just about the raw rate of return. It's the mechanics of what you have available to you.
Right.
So you can't de-risk your portfolio, or you can't take outsized gains in your stock side of the portfolio to repay the loans on your whole life insurance policy if you don't own one.
Right. Very true.
And it's difficult. I've been doing this for a long time now. It's difficult to get to 65 and say, you know what I should do? I should add whole life insurance to the equation.
Yeah.
That's tricky.
Yes, it is. It doesn't work well in most situations.
So now you just lay on the table more outs in bad times.
Right.
More ways to sort of pivot or zigzag around the problems.
Mm-hmm.
Or you end up in a position, and this conversation took place in this case and several others that are like it. We get to the fifth year, for example, and we decide, okay, this is the point where we're going to stop putting money in the policy. So, should I put money in the policy? And the conversation was, well, if we look at year over year rate of return for this policy, any dollar that goes in this year, according to the information from the insurance company, and we already know what the dividend is, so we know this is going to happen, you're going to get, I think in that year, it was going to be like 4.75% on the money.
Right.
So if you know of some other place where you have a much bigger expectation than 4.75%, then go do that. Mm-hmm. But if you're kind of sitting on cash that you don't know what to do with, and you don't have something that's better than 4.75%, by all means, put it in the policy.
Right.
Because here's the thing. If you do that and you decide 2 years later, I shouldn't have done that, you just take it back out.
Yeah. Exactly.
And the last thing to point out, there's always the last thing with us, and it should be the first thing probably, So now well over $2 million of cash value sitting in whole life insurance.
Mm-hmm.
Way more than $3 million in the portfolio, the investment portfolio. And 20-some million dollars in death benefit.
Is that all? I thought it was more than that. Maybe.
So from an estate legacy perspective, a massive increase.
Yeah.
In what can go different places. And over the years, there's a very interesting trend we have observed. It causes us to giggle a little bit. And that's not us making fun of anybody. And it's not something that will make fun of any of you who come to us and want to buy life insurance. But when people come to us, 9.9 out of 10 of them tell us, I don't care about death benefit.
Yeah.
I just want to optimize the cash value.
Right.
Which we do.
Mm-hmm.
Then the policy is put in force. And sometime in the future, we have a conversation and we bring them, or we bring the awareness that, hey, you stopped putting the money into the policy, for example, or you didn't end up putting the amount of money that you thought you were going to put in there into the policy, which means we have some capacity to reduce the death benefit to further optimize the cash performance from here on out. Very few people take us up on that.
Particularly if you're not planning on putting any more money.
Yep. Yeah. Very few people take us up on that.
Right.
I think I can still count on one hand the number of times people have said, yep, I want to do that.
Right.
Turns out that once you have that multi-million-dollar death benefit in force, you look at it and you go, that's kind of nice.
I'm resting a little easier, not worried about what's, if something happens to me.
Yep.
Yeah. It wasn't important before, but now that you have it.
The other thing that always happens to the ones that are married, whenever I bring that up, is I got to talk to.
Yeah, exactly. Just go ahead and say it. I got to talk to my wife about that. It's always the guys.
Yeah. Yep.
Yep. And then we never hear from them again.
Nope.
Turns out they talked about it.
And look, this is the really cool thing.
Or they decided, I probably shouldn't talk about it.
This is the really cool thing.
You need $10 million. You'll be fine.
We don't need that reminder. We had a little disagreement this morning. So, yeah. But here's the other thing. I mean, lots of times when we bring this to people's attention, like the change in cash value is not going to change anybody's life.
Right.
Like if we do this 10 years from now, we'll go from a 5% rate of return to a 5.1% rate of return, something like that. Probably less. And so that difference in terms of raw dollars, I mean, it's not going to, you'll be able to buy an extra ice cream or something like that. So how cool is it that we can keep millions of dollars of death benefit more than we need in some cases, or at least a few $100,000. And the overall net impact on our cash is trivial at best.
Right. It's a pretty good deal.
Mm-hmm. I should clarify that that's true once the policy has been enforced and you've been funding it at some higher level for a while. Not true from the inception. So for those who have way more death benefit than they need at the outset, that has a compounding negative effect that's way more pronounced.
Yeah. Exactly.
One of those insurance pro blog pro tips that seems very technical. Kind of is. But there you go. So yeah, if you got the money and you want to put it in whole life insurance, you can. We've focused explicitly on whole life insurance because that was the case study here. You can effectively do all of this with index universal life insurance as well.
Sure. Yep.
And a lot of the same principles apply in terms of short pay, a couple different design aspects to it, different from somebody who does not have all of the money right now and is just going to pay premiums out of income, for example.
Right. And you do have a fair amount more flexibility, actually.
Yes.
As you get into the future, if you get to the end of that hypothetical 5-year period or something like that, if you said, I think I want to keep going. Okay.
Not according to certain AI Yeah. Not according to certain AI models, which is a
I know.
conversation for another day, but stay tuned. It's coming. And yeah. And that's all I have to say about that.
All right. Sounds good.
So I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.